Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jarod Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another episode of the Optimal Wealth Podcast. I'm your host today, Jarod Alexander, and today we get the pleasure of speaking with our guest, Mike Sullivant. Mike, welcome to the show.
Thanks, Jarod. Happy to be here.
Yeah, glad to have you here. You know, we were just discussing right before we got started, we both came from a long 3-day conference here in Phoenix and kind of recuperating a little bit from that, huh?
That was a good time, man, and the best time of year to be in Phoenix. So it's hard to beat, no humidity and 70-degree weather.
Yeah, you definitely can't beat that. That's why I live here for sure. So,
well, I brought some back to Kansas City with me. It's, I think, 75 and partly cloudy today. So I got a good setup. But this is February, so tomorrow could be 10 degrees. Who knows?
Yeah, no, you can't beat that. North Carolina's the same way where I'm originally from. One day it's 80 degrees, the next it's 30, 30 at high. Yeah. But, and if anybody, that's listening to this, so Mike here has got his background, he's got the woods behind him on the deck, peaceful, birds chirping in the background here. So, yeah, you gotta love it. Gotta love it, right, Mike?
Love it.
All right, well, let's dive in here, Mike. If you could, why don't you tell us a little bit more about your background and how you got involved in real estate?
Yeah, it's really kind of real estate from day one. So I'll kind of give you the short version, but worked my way through college doing property management kind of by accident, and really carved out a career for myself. By the time I came out of college, got a business degree and came out with 3.5 years of experience in real estate managing property. So the quickest, fastest way for me to make money was go the corporate route. So went into corporate multifamily, kind of large scale national companies that had 60 plus thousand doors across the nation, and just worked my way up the corporate ladder there. Got halfway through my career disenfranchised kind of with corporate world and started pivoting to investing myself, managing small business, and kind of have through that experience landed here in more of the private equity side, commercial real estate side of things. And so I've been raising capital with Aspen Funds. We're based out of Kansas City, and so my role there is capital development and working with other fund managers, working with high net worth retail investors. Not unlike those that I've worked with you, Jarod. Work with some institutional type investors. So really my role is working with our capital team to raise capital for all of our funds. So we're a diversified firm and investing in lots of different asset classes, kind of ranging from mortgage note funds, a slew of real estate asset classes, multifamily, industrial, retail, and as far as oil and gas funds. So a lot of unique diversified options. But yeah, that's the short version of how I found myself here.
Yeah, no, that's awesome. So right out of college, you went to go work for this big firm and been in multifamily or real estate ever since?
Ever since, I started doing some investing myself, but really cut my teeth on, the most institutional grade there is. I mean, some of these companies just operate with the utmost efficiency. So really, I think multifamily is probably a perfect example, particularly within commercial real estate of how efficiency actually looks. And so cut my teeth on understanding really top to bottom. Like, I know what it's like to work with tenants. I know what it's like to, get calls in the middle of the night to deal with the deal with a maintenance issue. I know what it's like to work with, institutional investor that wants to cut you a $5 million check. So I've kind of seen all aspects of real estate, top to bottom, and a lot of different asset classes. But yeah, it all started in Manhattan, Kansas, little Manhattan, Kansas, being a leasing assistant at the local property management firm.
Okay, cool. Well, so it sounds like you got a little peek behind the curtains. A lot of us have the story of, read the Rich Dad Poor Dad or come right from corporate, or and just don't even really know about this type of investing, especially like apartment syndications in the private equity space is, what we focus on. So I mean, yeah, so you got a peek behind the curtains there and started working your way up and learning about, these types of investments, these assets you can invest in. Now, did you
Yep.
start when was your first passive investment? Yeah.
Well, I was more an active investor first. So, the easiest on ramp to that is, flipping houses, right? So
Gotcha. Yeah.
certainly done my fair share of that. And then kind of worked my way up doing, I would say, more enterprise level of flipping houses, ran an organization and helped run an organization that was flipping, 200 plus homes a year, mostly in Kansas City, but in some other markets around the country. So my first passive investment started coming when I got rid of my active properties that I'd been managing, which I quickly found out trying to balance that with career um, is super challenging, right? It's a time suck for sure. So definitely moving all of my assets into passive investments so that I can continue to scale both my current role as well as continue to do more of these investments and make that kind of manageable for myself.
Yeah. And so your first ever investment was a flip. And then did you end up doing any long-term single family or
Yeah,
just,
long-term single family,
yeah,
rehab and hold type of properties, and
gotcha.
still have those here to today. A couple of those, so
Okay.
it's been a fun journey with kind of coming from the corporate side, which is very organized, very structured, and then getting into the bootstrapping of figuring out how am I going to flip this house, how am I going to get it, maximize the potential for this asset, and then how do I set this up long term to hold this.
Yeah. Well, I think it's definitely an interesting, depending on, what an investor is looking for, right? Because for me, I started out active in buying a single family. We were just talking about right in your backyard, actually, right outside Kansas City, Missouri there. And, I love the real estate space. I love being active, hands-on. And so that definitely attracted me. But as I got into it, saw, like you had mentioned earlier, you talk about, they talk about the three T's: tenants, toilets, and termites, right?
Yep.
And I actually, I mean, I'm in Phoenix and I'm, investing, 2,500 miles across the state. So I definitely had a property manager, but I still had to manage a property manager, right?
100%.
And I'm still working a full-time job, it got, it got to be not as passive as I thought, right?
100%.
Yeah,
Nobody's going to manage the property better than you are because they're not the owner, right? The
yeah,
owner's interest is really where the wealth is created is uh, is through ownership, right? So property management obviously is a critical component of execution for any investment. You have to have it. It's so critical. But when you're using third party management, it's a classic middleman type of situation where they have their interests, you have yours. There's a little bit of alignment there, but nobody's going to manage it better than you. And so relationships and scale become the issue, particularly in single family. It's very difficult to scale. This isn't, property where we've got cookie cutter. This could be a portfolio of, thousands of homes around a given market, or even in some cases, remote management across the country. So my experience with property management is it is a very, very challenging industry, both as a manager and then from an investor's perspective, as how to how to create alignment of interest and ultimately ensure that your property is getting the attention or even more attention to the next. It's a challenging particular subset of real estate. So a great wealth building tool, but from a management perspective, very difficult to scale and align interest.
Yeah. Well, and I think you hit it where you talked about scale, right? Because that was my biggest. I mean, the idea was to create more time freedom, right? Replace my expenses so I can have the option to be work optional or spend my time where I want. And scaling, I mean, I did the math. I would probably had to buy like 60 houses, right? That cash flowed around, 150, $200 a month to hit the number I wanted, my goal, number I wanted to be at. And I just, after doing that first one, I couldn't imagine going through that 60 more times and then still having to be involved in a lot of the day to day, even though the property manager handles most of it. I mean, when there's repairs coming up, you gotta dive into those, kind of vet vet the property manager, so to speak, on what the repairs are
100%.
and if they're, the price is right too, right?
Exactly.
Yeah. And then I wanted to touch on that because I think it's important for an investor getting starting out in this space, because a lot of people just have that mindset, I'm going to go buy a single family home, just be active, hire a property manager, which is exactly what I did. And Mike, you as well, right? And so, but this podcast is tailored to help and educate the passive investor. So more of the private placement offerings that we specialize in, Mike, and especially you and Aspen Funds. And so I really want to dive into that for the investors is, what type of offerings Aspen Fund, and you touched on a little bit, but kind of diving a little bit more. And I want to focus on the two asset classes that, depending on how much time we have, I want to focus on the debt
Yeah.
fund you had mentioned. So if you could, before we even start there, explain the difference of growth, what a growth investor looks like, and
Mhm.
a cash flow investor, because I think that's a good segue leading into the debt funds.
Yeah. Well, I think an investor can be both. They can be either or. So there's a lot of different ways. I think here at Aspen, a core tenet for us is diversification, right? So cash flow, growth. Sometimes you can find investments that have both, not as common, right? But on the debt side in particular, to kind of address that, we've structured a lot of investments historically, and kind of the genesis of Aspen has been in debt funds. So we've got a long track record of operating, in particular, mortgage note funds that were focused on residential properties. Um, in the wake of the great financial crisis, kind of this marketplace of non-performing and reperforming first and second mortgages on like single family owner occupied homes around the country, really it took shape. And so we were one of the early, more significant players in buying up these notes, asset managing them, and creating pretty significant returns for our investors. So we've got a lot of experience in that space. There's a lot of different types of debt instruments when you're talking about real estate assets. So we can get into that a little bit more. But the upcoming debt fund that we have is what we would call private credit. So private credit really encapsulates a few different scenarios, but primarily what this is focused on is what we call preferred equity and mezzanine debt in commercial assets. So for multifamily, for example, if you got an apartment complex, a common situation that we might see in our industry is somebody who's buying a multifamily asset from a seller. They're assuming the Fannie loan from the seller, but that assumption only covers maybe 50% of the purchase price or 40% of the purchase price. And in order to achieve the value add, typically the improvement plan, in order to execute on that, normally more capital is needed. And in a way that can be done is through gap funding, bridge funding type of uh, debt solution. So private credit is able to step in, particularly when banks are really tight right now and rates are high. This is an opportunity for for private funds like ours to step into really good quality assets, come in a little bit lower in the capital stack, meaning, your senior debt has that first lien position. Mezzanine is a secured type of instrument, so it's taking a lien position. Pref equity isn't secured, but it's typically you don't have both senior debt and mezz and pref. It's typically mezzanine or pref, one or the other. So what we've found is these really great opportunities, and the marketplace is really, really strong to be able to come in and get pretty decent returns, low mid-teen type of returns as a limited partner investor, a passive investment. And again, come in a little bit lower in the capital stack, so it's a little less risky, which also provides a little bit more cash flow. So these debt instruments are typically geared towards cash flow, but then we can boost up some of the returns by creating an equity component on the back end of these assets, which kind of gets the returns a little bit higher. So that's kind of an introduction to that. So I'll let you ask any further lines of questions that you have on those type of deals.
Yeah, no, thank you for that explanation, Mike. And yeah, I guess a couple questions. One that came to mind is, when an investor, and you touched on this a little bit, but I just for a little further explanation, is when an investor is looking at, okay, do I invest in a multifamily value add, right? Where I'm getting, and these are just projections, examples of some multifamily
Of
deals we've
course,
done. These are definitely not,
you're not representing a return.
we're not representing in return. Thank you, Mike. But 5 to 7%, cash on cash. Typically they're average around 6-7%, right? And then you get the upside on the sale where you double your money in 4 to 5 years, right? And
Yep.
so when I'm looking at we talked about the cash flow. So as an investor, I'm just going to ask it outright. What is it less riskier to invest in a debt fund compared to a multifamily value add?
Yes.
Okay.
So the risk continuum, when you look at just alternatives in general, you'd have kind of at the baseline what would be what we call, so core would be an asset that's been improved. There's really no extra value to be added other than that which the market would bring in terms of rent appreciation. So typically core type assets are newer type, so you got a new construction or relatively new multifamily asset that's been stabilized, meaning it's already been rented, it's full, it's operating, it's efficient, and there's not a whole lot of risk because it's already stabilized. So if I went and bought a brand new building that's already leased up, we're achieving basically market rents, I'm not taking that much risk because I'm not speculating very much on how this is going to perform. I have financials to support, I have all of the rent roll to support. What is this going to yield for me? And so that core type of asset is basically, there's very little risk. So that's why typically institutional type investors are buying that, because they have larger sums of money. Their primary focus is preservation of capital. And because they have large volumes of capital, they don't necessarily need to go get, 12, 14, 15 plus percent returns. They would rather just ensure that they're, first and foremost, they don't lose what they already have. So I can take something more conservative, that's just conservative cash flow, stabilized. I don't have to do a bunch. I don't have to dump a bunch of extra capital into this asset. So that'd be core.
Right.
Core plus would be, an asset similar to that, but there's some, additional value to be added. Typically it's like an underutilized type of asset, or, something where there's a very light value add, like a property that's been mostly rehabbed, 70% rehabbed. They're achieving the market rents. We just need to finish this business plan. And so we're not having to speculate that much because we're already achieving, market rents. We have a basis, but we are having to speculate on cost for adding that value. So those would be kind of core plus. Debt would typically kind of fall more in that range of risk, in that core to core plus type of returns and risks. So not having to speculate that much because we're in a debt position. You're typically either in a lien position where you're getting paid first, or sometimes just after the senior debt, but there's usually some type of mortgage component where you're receiving that. Now that's not all debt. I'm generalizing here, but
Right.
most often debt is a little less risky in that sense. Then you've got value add, which it could be that center point where maybe got a little bit older vintage type of property. This is a 1980s build or 1990s build, and it's not distressed, but it is needing some improvement to really maximize the use for this asset. The highest and best for this is to come in, put some capital into it so we can really achieve market rents. We're having to speculate more on costs. We're having to speculate more on a larger total cost, because it's not just a portion of the rents that are being achieved. It's like the property really has not been improved. So we're having to speculate on what the future outcome of our value add is going to be. So inherently a little bit more risky, thus the returns have to be a little bit higher. Then you have something like development, which would be, brand new development. There's a few different types, but brand new development, we're speculating on the building costs, we're speculating on timelines, we're speculating on the rents we'll achieve. This is generally higher dollars too, because it's brand new construction, so we're paying the current rates for materials. Like real estate really is just a bundle of commodities, wood and concrete and wiring and plumbing and all these things. If they already exist, you don't have to speculate on building those. But in development, you have to speculate on those.
And
And
would you
so
say that would
cost.
would you say development would be more risky, more on higher
Yes,
risk? Yeah. Yeah.
in that sense. I mean, there's ways that you can mitigate, risks, and there's, this is a generalization, just kind of give the spectrum of risk. Really, what that is, this helps determine what kind of reward I should be getting, right? If I'm looking at a value add and a really solid business plan, and I'm looking at a development and a really solid business plan, those returns are exactly the same, and the fundamentals are pretty much exactly the same. Value add would probably be the way to go in that situation, because I'm not being compensated for some of the extra risk. Whereas development, the potential return should be higher in those type of situations. So that's not necessarily a blanket statement, because you might be looking at differences in market, differences in some of the underlying fundamentals. But again, just as a simplification, that kind of shows. And then the final one will be something more opportunistic. So this would be for us, for example, would be oil and gas. So this is a commodity. There are a lot of uncontrollables that are dictating where oil gets traded at, right? We don't get to pick and choose what that gets traded at. It's not simply, hey, I go and I spend a controlled amount of money to go get more rent, and then that rent is trading at a certain cap rate and creates the value. Oil and gas is inherently more risky. There's ways you can mitigate risk, but generally that's an example of something more opportunistic, that the reward needs to be higher in those situations. So that's kind of if you're looking at alternatives, that would be the spectrum of risk.
Yeah, no, and thanks for spelling that out. And real quick on the oil and gas, because I'm super new to that space, but I know there's definitely a few benefits that caught my interest. One being that you can take actually the gain or the losses against your active income,
Yeah,
which is huge, right?
it is huge.
But if you could explain how the returns, again, these are just projections here, but how the returns work on oil and gas. Like you said, there's a lot more upside. What does that look like? If I put $100,000 in, am I doubling or even tripling that in 4 or 5 years, or is it more cash flow, or what's the biggest difference there?
Yeah, so just generally for the industry, there's a range of possibilities. So it depends on how you approach it. So just how oil and gas usually, in our situation, I'll kind of speak to that. as well as maybe some other things for people to be aware of as things to do due diligence on, things that add risk in oil and gas. So pretty common, just like you said, there's big tax benefits available. Usually those are attributed to development, the development or redevelopment of non-performing wells or wells that don't exist yet. So there's big tax benefits. One of those, kind of the big one, is called intangible drilling costs. Those are costs associated with the development, and that's where these big, huge tax advantages are. So what can be attractive from an LP's perspective is, hey, I'm a doctor, I'm highly paid salesperson, I'm a dentist, I'm a lawyer, whatever that is. I'm making more than, say, $300,000 a year gross, and I'm just getting crushed on taxes. I don't have anything that can offset that for me, but oil and gas has this unique opportunity. So it's obviously attractive to go and offset your ordinary income. So typically when you hear in the oil and gas space, if you hear an investment that says, hey, you've got 80, 90% plus tax write-off of your ordinary income in the first year, generally what that's an indicator of is this is either a non-performing well or some type of well that doesn't exist already. And we're raising capital to go dump it in to develop this. And inherently, that's more risky because you don't already have an income component. This is the way that's generating these losses, is because there's basically 100% loss. We put everything into this and we're speculating on if we will generate a return either through cash flow or being able to eventually sell this asset. So it's often referred to as exploratory drilling, wildcatting. Those would be kind of common terms. So inherently, that type of investment is more risky versus there's a few other ways you can invest in oil and gas. But if you're purely talking from the way that we approach it, would be in the middle market in particular, there are existing wells that are already producing. So these would be called proven, developed, and producing wells. Mm-hmm. And what the revenue that's being generated from that production oftentimes has been split. A percentage of that revenue is going to private capital or private equity that has purchased interest in the lease, the lease that's generating, or that the lease that the operator who's doing all the drilling owns. So say they originally bought 100% of the interest of that lease, they will sell off a portion of that to private capital because of a very capital intensive industry. So somebody like Aspen, what we've been able to do is come in and purchase the interest that's already been split from other private equity groups who are reallocating that cash into other asset classes, or sometimes they are operators themselves and they have a more lucrative opportunity. So they're taking, selling this asset so they can go make money elsewhere. So we can step into that and we buy into that in the most recent fund that we just closed. We're buying into that existing production at 19% cap rate. For those that are not familiar, that would be 19% cash on cash return year one.
Yeah.
So a significant amount of cash flow. And in those same fields that are already producing, many of them are not fully developed. So there's more opportunity to continue to develop. And in that same area that's already proven, it already has proven reserves. Proven is an actual designation that requires geological study and engineering reports to say how much reserves would be in that field, basically. So then we can contribute capital additionally to the development, which is what creates some tax benefits, but also de-risks, because we're not speculating as much of, are we going to generate income? Because we're already generating a lot of income from the existing production. So that's the way we've approached it. We've so far seen a lot of success. We partnered directly with an energy advisory firm who they themselves are geologists and engineers that provide the technical expertise to really de-risk as much as possible. But it's still a commodity. Still our returns are contingent on being able to develop, prices staying at a certain basis. So we can get into more of that if there's specific, interest and you want to dive deeper there. That's a whole rabbit hole, but that's kind of an overview of how generally in alternatives, those would be the types of investments. So more often it's development without an income component on the front end and a lot of tax losses. We've got kind of a unique strategy of a little bit of both. And then there's a more conservative way, which would be mineral rights, which is I own the rights. I just get a royalty from the operator when they're pulling reserves out of the ground, basically. So you just kind of get paid, but there's really no tax benefits when you're a mineral rights owner.
Gotcha. Well, yeah, which wouldn't make sense if someone's, working a W-2 and wants to take those tax benefits against ordinary income.
Exactly.
The first option would make a lot more sense. So, thanks for clarifying that. I guess just one follow-up question on that. So you just said you closed the fund, oil and gas fund just recently. What does that look like on like a business plan? So as far as like the multifamily, it's probably what I'm most familiar with is, you get your 5 to 7% cash on cash return, your average, right? And of course you see the IRR, average annual return, in the high teens there, and then of course you got the 2x multiple, which means, if you put $100,000 in, they're projecting you're going to double your money in 3 to 5 years, 4 to 5 years, whatever that is, right? How is oil and gas? How is that structured when you're looking at the returns from an LP side?
Yeah, returns should be higher in oil and gas because there's more risk, or at least from an underwriting perspective, you should have a business plan that's achieving, 25, like we underwrite a 10-year horizon and a 25 to 30% IRR over a 10-year span. So for those that are not familiar with IRR, that'd be internal rate of return. So it's a cumulative return of both cash flow and any equity, and then adjusted for the time value of money. So over a 10-year cycle, what a 25 IRR would be, 25 to 30% IRR would be like a 4 to 7x on your money over that 10-year period.
Yeah.
So you throw 100 grand in, I make somewhere between 400 to 700 grand, and it preserves my capital. So that's kind of how we've structured that specifically. If you've got, you got some deals that might be a shorter span of time. They underwrite something shorter where we're developing and we're selling and we're trying to achieve this in 3 years or something like that. The numbers can vary a little bit, but generally you need to be outpacing what you're seeing in value add multifamily for sure. Yeah. This wouldn't be a situation where you just want to double your money in 5 years because the risks are greater. So we would generally want to see in our case 4 to 7x over a 10-year.
Yeah, no, thanks for that clarification. And then like you had mentioned, I mean, you're buying these at 19 cap rates or roughly around there. I mean, so they're cash flowing from day one as well, right?
Cash flowing from day one, exactly. Yeah. So the piece of that's important to kind of see a difference between a real estate asset and oil and gas would be oil and gas, and why you have a really high cash on cash return is because it will one, the risk is higher, and two, your resources deplete. Unlike value add multifamily, this is an appreciating play. This is right. Rents will naturally appreciate, values will in turn naturally appreciate. So this is a play to go maximize the net operating income of this asset. I have a bit more control over getting there. Oil and gas is like you can mitigate, but none of us can control commodity prices. Like I can't control a COVID type of situation that could see the bottom fall out, right? So investing inherently is risky. And if you're investing in something more opportunistic, then the return needs to be significant because the risks are generally higher, even if you've mitigated those.
Yeah. No, thanks for that clarification. I think that was a good sum.
Yeah.
what you were talking about there. And
So our view would be across all these assets, a core tenet or just investing in general is diversification, right? Don't put all your eggs in one basket. So it'd be the same as like, I shouldn't buy just multifamily in Kansas City and put all my money into that asset class, that market, because I'm going to get pretty similar outcomes generally. Obviously, executing business plans, can go varying degrees and that can affect the outcome. But just from a high level, diversification is a way for us to ensure that we preserve as much of our capital as possible and we're outpacing inflation. We don't want to deflate by just holding on to our cash, making as much money as we can from our W-2 job, holding on to that cash for dear life, or putting it in, to the traditional systems that, have historically been very volatile, right? Up and down. So getting into alternative assets gives you the opportunity to go a little bit more direct, get a little bit more direct ownership with something that has a specific purpose and a specific business plan. So that's why we do what we do. We look at macroeconomics and we condense that down into, we feel like right now oil and gas is a great asset to be in, and here's XYZ reason why from, the macro perspective. And then we've created business plans to kind of execute on the trends that we're seeing. And likewise with debt, like you're probably seeing it in multifamily as we are. There's kind of unique opportunities right now in private credit to get in, and the debt market in those particular commercial assets is really strong from a return perspective right now. So we can come in and reduce some risk, provide some cash flow, and create some liquidity options for investors that don't necessarily want to be locked up for 5 years, 7 years in a value add type of play. I want to have the ability to redeem my position after a period of time. So that's kind of why we provide all these different options to really cater to one, somebody that's looking to diversify, two, different needs for different people that may not necessarily need the diversification. Somebody who just sold their business is probably looking for cash flow because they're looking to replace their income that they got from their business, versus somebody who's younger and looking to grow their basis might be more growth focused and trying to get into some of these real estate assets where I can have a little bit better upside on the growth. So it's all a matter of who needs what and when, and then having options that are actually investable and are going to create the return.
Yeah. Well, and this is one of the big reasons, I like Aspen Funds, Mike, and what y'all do there is, I mean, you pretty much have those opportunities spread across the board. So, I mean, anything from industrial to the debt funds, oil and gas, multifamily, storage. I think y'all have done so. And Mike, you hit it. I think it's really important as an investor, whether you're seasoned or just looking to get started in this space, is determine what are your goals? What are you looking for, right? If it is to really offset your ordinary income, oil and gas could be a great option, but there's a lot more risk involved there. But there's debt funds available so that you can get higher cash flow, and there's, you still get losses. You still get all the tax benefits of real estate, even with those. So you get the depreciation losses on your K1 every year, which you can, talk to your CPA, of course, but there's some tax strategies involved in that as well. So
Totally.
but more so it's just, determine what are your goals, what are you looking to achieve. And Mike, you hit it. Just that diversification. Don't have all your eggs in one basket, right? But I will share. I mean, one thing coming out of this weekend, Mike, at this event we were at, is like, the common theme was real estate's 20 to 25% off right now, right?
Totally. There's big buying opportunities this year.
Yeah, a lot of opportunity. And so, this is definitely a time to start educating yourself and really looking at what you want to invest in, and learning about these different asset classes. And Mike, I wasn't really expecting we get that deep into oil and gas, but I'm glad we did, because I learned some stuff too. I hear about it, on podcasts or from different people here and there, but I actually haven't got the explanation. You did a great job too, by the way, of explaining, just the benefits and the different sectors of oil and gas as well. So thank you for that.
Yeah, you bet. We're happy to
Um,
be a resource and love what you got going on.
yeah, absolutely. Well, and one of the reasons why Mike's on the show is we had a conversation prior to this and definitely looking at, potential partnership here in the near future. And I love
Yes.
the debt fund structure they have, and now I love the oil and gas that they have to offer too. So we'll see. Yeah, see what comes of that in the near future here. So all right, Mike. Well, yeah, I think we got a ton of value there. I'd like to go ahead and transition into what I call the fire round. Let's do it here. What I'm going to do is I'm going to ask you 4 questions. The first one being if you could recommend a book on real estate for investors just starting out, or something that helped you when you got started, and another book on cultivating a particular or a positive mindset. Just like a mindset book.
Yeah. So mindset, a book that changed my life is called Extreme Ownership. So you might have heard this is Jocko Willink,
Yeah.
ex Navy SEAL. Him and his compatriot Leif Babin wrote an incredibly. They've actually got a series, but their first one that really changed things for me was Extreme Ownership. So tons of leadership principles there. I think both in business and in life, relationships, all of these things can be a core, uh, a core value for people that can really help them accelerate the results in their life. And I've definitely seen that in my own and accelerating the necessary change to level up for myself. So that's been super meaningful. I'm trying to think of real estate ones that have been, game changers for me. I mean, the obvious one that probably everyone has read is Rich Dad Poor Dad. I think that's a great one if people, depending on where people are in their investing life, is if you're actively working and considering the values of real estate and just investing in general. I think this gives you a lot of core tenets. It's not going to give you a whole lot of execution and tactical advice, but it tells a wonderful story and will really help people. So that was the book that changed it for me when I first started investing. So I'm sure that's the case for many people. Um, Something more tactical. I'll have to get back to you on that one. I need to think about the ones that have really impacted me tactically. I don't have one top of mind.
That's okay. We'll go with Rich Dad Poor Dad. And I know for me, it just opened me up to a whole different world, right? We're
Yeah,
raised, in that go to school, get a job, work 40 years in the workplace, whether it's corporate or whatever, and retire and hopefully you got enough money to live off of for the rest of it, and
yeah,
Rich Dad Poor Dad just, opens the floodgates and gives you a whole new perspective on what's attainable and achievable. Um,
yep.
and so, and it's funny you mentioned the Jocko Willing because the past 2 guests on my show, Zach Happenstall and another guy who was in the army prior to getting into investing, most referenced David Goggins.
Yeah,
So past 3 books have been by Navy SEALs there.
they got something figured out.
They
Those are intense guys.
they do, man. Have you read the David Goggins book at
I
all?
have. It's so good, so
Right.
good.
Yeah, I just read that. After they recommended, I'm like, I got to read this book now. And yeah, great story. And just there's no excuse, right? It's no excuse. Kind of like Jocko Willink, got to take extreme ownership.
Yeah,
And yeah,
be the solution.
yeah, absolutely. Next question here. And I think we kind of already answered this, but I'm gonna go ahead and answer this anyways. We can just do a brief one here. What is the practical first step the audience can take to explore the space of passive investing?
Practical step would just be taking an honest look at your current income and coming up with basically a roadmap for how much income am I going to need and when to replace my active income. So the whole objective, obviously, with passive investing is not to just have like the traditional model is throw all your money in an IRA, build up a nest egg, and draw it down till you die.
Mhm.
But what's missing when you retire is income. Income is what you really need. Income is what you need to replace. And so coming up with that number, if it's, I need $150,000, I need $200,000, whatever that is to comfortably live off of, cover my expenses and continue to put money away, whatever that is, it's 500,000, is come up with that number and reverse engineer it. So say, if I want to retire in, 5-10 years, I'm going to need this amount of income. And that will really help dictate what are the type of assets I need to get into today to get me closer to that outcome. So it's really just taking a hard look. I mean, there's a lot of resources out there. So, get partnered up, find Jarod, get partnered up with somebody who gets it, somebody who started this journey and can be a guide for you. And so that would be, I would say, step one for someone who hasn't begun, is really just take a hard look at that. And that's going to help dictate, who and, who you talk to, and then, how and when you execute these passive investments to get you closer to your income replacement.
Yeah, no, I love that answer, Mike. And it's just kind of going back that book you just recommended, right? Taking extreme ownership of, your life, your finances, and start with the end in
Yeah.
mind. And like Mike said, reverse engineer that. And it's pretty powerful once you start taking action and getting these numbers on paper.
Yeah.
It's a mindset, right? I mean, we heard this from a number of speakers too at the event. I mean, 80% of this is mindset, right?
Yeah.
20% is just actually implementing the plan.
Yep. That's exactly it.
Yeah. So yeah, no, great answer there. And question number 3, what is a daily habit you practice keeping you on track towards your goals?
Yeah. Gratitude, I would say, is number one. There's a lot of new information and research and resources out there about the power of gratitude. So I would say that for me, it actually they're proving it neurologically that it actually rewires your brain, and so we can see the impact of that immediately. There's always something to be grateful for. So gratitude is a way that I start my day uh, every day and lay out everything that I'm grateful for today. You can find gratitude even in the hardest of situations. That's going to give you the right mindset to then go tackle your day and set a course of intentionality for your day. So that's a big one for me.
Yeah. Yeah. No, gratitude is everything. Something cool, a little sidebar is my wife and I, started doing this thing. We're at at least once a week, we're trying to just tell each other things we're grateful for, in our relationship and our personal lives. And it's just amazing how much more connected we become after that. And yeah, I mean, it's a powerful exercise. It really is. And another thing I do personally is I write down 3 wins at the end of every day, right? Because it's so easy to focus on that one thing you didn't do, but 3 wins, and whether it's just I went to the gym, I worked out, I was present with the kids, whatever, right? Just looking at 3 positive things for the day just kind of
Yeah.
helps keep me in that mindset, right? Or get me out of the negative thinking for sure. And then last and final question, if you could be remembered for one thing, what would that be?
One thing. I want to be so many things. So that's the that's the balancing act, right? I think at the end, like, I'm not gonna really remember or even care or be able to benefit from, you know, any and all the money that I've made, but I will care and be remembered for the legacy that I leave to my family. So my big why is my family and my children. So I want to leave a legacy of love and intentionality with them, and I want to leave a financial legacy for them. So it's less about me getting the next thing and being able to buy this or that. It's really about being able to set them up and give them some security going into an ever changing and an ever challenging world. So yeah, the legacy that I want to leave is those 3 things.
Yeah, no, love that answer. And for those that don't know, Mike's got 3 little girls there. So Definitely
I
got his
do.
hands full, but no, I love that answer. And that's real similar to my why is, you know, I want to be present with my family and set them up for success too, you know.
Yep.
Yeah. Mike, great podcast here. I think the listeners got a lot of value, especially diving into some different asset classes. So thanks for touching on those. And for listeners that want to connect with you, learn more about Aspen Funds, if you could share where they can connect there.
Yeah. So aspenfunds.us, that's our website. That'll give you super high level of what we're up to. You can start to dig into any offerings that we have, but yeah, hoping to partner with you, Jarod. So anybody listening, connect with Jarod. He can keep you up on what we've got going on. Me specifically, it's Mike Sullivant with a T at aspenfunds.us. So feel free to reach out. And you can also find us on our podcasts, the Invest Like a Billionaire podcast, so hosted by our principals, Bob and Ben Frazier. That'll give a lot of investing wisdom. We bring on a lot of high-powered guests on there and gives just a lot of investing insights. So all of that's centered around how the ultra wealthy billionaires allocate 50% or more of their own capital into alternative assets. They're not just keeping their money in the stock market. They're not just keeping it with their financial planner. They're putting that money to work actively into alternative investments in real estate and other assets. So that's kind of the premise for our podcast. So yeah, we'd love to see you on any of those.
Absolutely. Well, yeah, definitely encourage y'all to connect with Mike and Aspen Funds there and definitely go check out that podcast. I've heard a lot of great things about it. For sure. And two, if y'all, got any value out of this podcast, we encourage you to share it with a friend or a family member, right? Our whole goal of doing this is just to help educate others on these alternative investments. So with that, Mike, thanks again for joining us, and I'm sure we'll be talking soon.
Sounds good. Thanks, Jarod.
Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.